Markets just hit record highs. Big tech is pouring over $700 billion into AI, and most people still can't define the financial terms that decide whether they build wealth or just watch other people build it. That changes today.
Welcome back to the RoxyEZ Wealth Report. I'm Professor Roxanna Ezenekwe. If this is your first time here, our mission is simple. We turn today's money confusion into lasting money confidence. In this issue, Volume 6, I'm covering 4 critical topics. We'll cut through the noise to see where the markets actually stand. We'll explore how the AI boom is quietly reshaping your investments. I'll give you 20 financial terms to build your literacy. And finally, we'll map out the smarter way to pay off debt and plan for a retirement that almost nobody is truly ready for. Each section is designed to give you actionable insights. So grab a notebook and let's get into it.
First, the headline. The markets are hitting record highs. You've probably seen it flashing across your screen, a big, bold number that feels both exciting and a little intimidating. The S&P 500, a key benchmark for the entire US stock market, has pushed into new territory. Now, what does that actually mean? The S&P 500 isn't some abstract concept. It's a snapshot of the health of 500 of the largest, most established public companies in America. Think of the brands you use every day, from the technology in your pocket to the food in your fridge. When this index hits a new high, it means that, on average, the value of these corporate giants is at its peak. It's a sign of broad economic strength and investor confidence. But with great heights comes great uncertainty. The question on everyone's mind is, what happens next?
Now here's what I want you to hear. A record high is not a reason to panic, and it's not a reason to throw your whole paycheck in either. It's a reminder that markets are cyclical and that our emotions often get in the way of smart decisions. When you see headlines about all-time highs, your brain might jump to one of two conclusions. Either, I've missed the boat and it's too late to invest, or, this is my chance to get rich quick. Both are traps. Let's talk about something called a drawdown. That's the financial term for a peak-to-trough decline. Every single bull market in history has been punctuated by these drawdowns. They are a normal, healthy, and inevitable part of investing. The media loves to sensationalize them, but seasoned investors see them as opportunities. The fear of a potential drop often paralyzes people. They wait for the perfect time to invest, a time that, frankly, never arrives. This brings us to a core strategy that thrives in any market condition, especially a volatile one: dollar cost averaging. Instead of trying to invest a large lump sum at the absolute perfect moment, a strategy that relies on pure luck, you invest a fixed amount of money at regular intervals. When the market is high, your fixed amount buys fewer shares. When the market dips, your same fixed amount now buys more shares at a discount. Over time, this smooths out your purchase price and reduces the risk of investing everything right before a downturn. When the market is high, your job isn't to time the perfect moment. Your job is to be consistent. The people who win long-term aren't the ones who guess the top. They're the ones who kept investing through every season. They bought shares during the Roaring '20s, the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. Their secret wasn't a crystal ball, it was discipline. They built wealth not by predicting the future, but by having a plan and sticking to it, month after month, year after year. We'll come back to exactly how to do that with just $5 a day a little later. So take a breath. A record high isn't a signal to sell everything or buy everything. It's a signal to check your strategy, reaffirm your goals, and trust in the power of consistency.
Let's talk about the elephant in the room: artificial intelligence. It's moved from science fiction to the front page, from a niche tech concept to a topic dominating boardrooms and dinner tables. And for good reason. AI represents one of the most profound technological shifts of our lifetime. And when a wave this big is building, it doesn't just change technology, it changes everything, especially the flow of money. To understand the scale, let's start with the foundation, the infrastructure. Think of it like the California gold rush. While thousands rushed to find gold, some of the most enduring fortunes were made by those selling the picks, shovels, and blue jeans. Today, the gold is data, and the shovels are the powerful computer chips, massive data centers, and complex software that allow AI to function. That's why big tech is spending over $750 billion on AI infrastructure. This staggering investment has catapulted companies like NVIDIA, who make the specialized chips essential for AI, into the ranks of the most valuable on the planet. This matters to you even if you never buy a single tech stock, because this foundational spending is just the first ripple. The next wave is how AI reshapes jobs, industries, and productivity. Consider a freelance graphic designer. Previously, their income was tied directly to the hours they spent creating. Now, AI tools can generate dozens of initial concepts in seconds. The designer's job shifts from manual creation to expert curation, refinement, and strategy. They can take on more clients, deliver work faster, and focus on the high-value creative thinking that machines can't replicate. Their productivity and potential income multiplies. This is the productivity ripple effect, and it's happening across countless sectors, from law and medicine to customer service and logistics. As these sectors adopt AI, capital flows toward companies that are either building the AI or are best in class at using it to become more efficient. This creates a massive sorting mechanism in the market. Companies that adapt and integrate AI to boost their margins and create new products will likely thrive. Those that don't risk being left behind. This isn't just a tech story. It's a story about new market leaders and laggards being created in real time. But with great opportunity comes significant risk. The biggest risk for an individual investor is getting caught up in the hype cycle. When a technology is this exciting, it's easy to hear about one hot stock and feel the urge to bet big, hoping for a quick win. This is speculation, not investing. Many early-stage AI companies will fail. The market will be volatile. And trying to pick the single winner is a gambler's game that most people lose. So, how do you navigate this?
Here's my honest take as your educator. Don't chase the hype, and don't ignore it either. The noise is deafening, but the signal is clear. This is a durable, long-term trend. You don't have to understand every chip and every model, or be able to code a neural network. You just have to understand the fundamental trend, that AI is becoming integral to the economy, and position yourself wisely. Instead of gambling on one name you heard about online, think broader. Position yourself with low-cost, diversified investing that captures the growth of the entire market or key technology sectors, rather than betting the farm on a single company. This approach allows you to participate in the upside of the AI revolution without being overly exposed to the failure of any single player. It's the disciplined, patient path. Remember, in a gold rush, you want to own a piece of the whole expedition, not just one person's shovel. Knowledge protects you. Hype empties your wallet. All right, let's dive into the part of the conversation that truly unlocks financial confidence. We're going to cover 20 essential financial terms. Now, I know what you might be thinking. Jargon, complexity, maybe a little intimidating. But I promise you, we're going to demystify these concepts together. Think of this not as a test, but as learning the fundamental vocabulary of a language, the language of money. Understanding these terms is the first, most critical step toward making smarter decisions and building real wealth. We'll go through each one, breaking it down with simple explanations and real-world examples. So get ready to take a screenshot, or better yet, grab a notebook. This is where your financial education gets a major upgrade. First up, number 1, asset. The simple definition is anything you own that has value or puts money in your pocket. But let's go deeper. An asset is a resource with economic value that you control with the expectation that it will provide a future benefit. Think of assets as your financial employees. They should be working for you. They can be tangible, like a piece of real estate, or intangible, like stocks or a patent. The key is that they either grow in value over time or generate income. For example, a rental property is a classic asset because it generates monthly cash flow and can appreciate in value. Number 2 is the opposite of an asset, a liability. This is anything that takes money out of your pocket. More formally, it's a financial obligation or a debt you owe to someone else. Liabilities are claims on your assets. Think of them as holes in your financial bucket. The bigger they are, the faster your money drains away. An everyday analogy is a car loan. While the car itself might feel like an asset, the loan is a liability because you have a legal obligation to make monthly payments, sending money out of your account. Other common examples include credit card debt, student loans, and your mortgage. That brings us to number 3, net worth. This is your assets minus your liabilities. Think of it as your personal financial scoreboard. It's the single most important number for tracking your financial health over time. It's not about how much you earn, it's about how much you buy free and clear. If your assets total $200,000 and your liabilities are $50,000, your net worth is a positive $150,000. The goal is to consistently increase this number by acquiring more assets and reducing your liabilities. It's the true measure of your financial progress. Number 4 is a concept Albert Einstein supposedly called the eighth wonder of the world, compound interest. This is interest earning interest. It's your money making money, which then makes even more money, all while you sleep. It's like a snowball rolling downhill. It starts small, but as it rolls, it picks up more snow, getting bigger and faster. Your initial investment is the small snowball. The interest it earns is the first layer of new snow. The next year, you earn interest on both the original amount, the interest from the first year. For example, a $1,000 investment earning 10% a year becomes $1,100. The next year, you earn 10% on $1,100, not just the original $1,000. This exponential growth is the most powerful force in building wealth. Number 5 is the silent wealth killer, inflation. This is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. It's the rising cost of living that quietly shrinks your dollar. Think of it as a financial headwind. You have to run faster just to stay in the same place. If inflation is 3%, that coffee that costs $3 today will cost $3.09 next year. It might not sound like much, but over decades, it can decimate the value of your savings if your money isn't growing faster than the rate of inflation. This is why investing is not optional. It's a necessity to protect your future self. Number 6 is liquidity. This is how quickly you can convert an asset into cash without losing a significant amount of its value. Think of it as financial flexibility. Cash in your checking account is perfectly liquid. Publicly traded stocks are also highly liquid because you can sell them and have cash in your account within a few days. On the other hand, real estate is considered illiquid. You can't just snap your fingers and turn your house into cash. It takes time to find a buyer, negotiate a price, and close the sale. Having enough liquidity is crucial for handling emergencies without having to sell long-term investments at a bad time. Number 7 is a cornerstone of smart investing, diversification. You've heard the old saying, "Don't put all your eggs in one basket." That's exactly what this is. It's a strategy of spreading your investments across various financial instruments, industries, and asset classes to reduce risk. The idea is that if one part of your portfolio performs poorly, other parts may perform well, smoothing out your overall returns. It's like having a well-balanced meal instead of just eating sugar. You wouldn't bet your entire life savings on a single stock, would you? Diversification means you own a mix. Some stocks, some bonds, maybe some real estate, across different sectors and even different countries. Number 8 is one of the best tools for achieving diversification, an index fund. This is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index, like the S&P 500. Instead of trying to pick individual winning stocks, you're buying a small piece of the entire market. Think of it as buying a sampler platter of the stock market. For example, an S&P 500 index fund gives you ownership in 500 of the largest U.S. companies. It's a low-cost, simple, and effective way for most people to invest for the long term. Number 9 is a reward for being an owner, a dividend. This is a distribution of a portion of a company's earnings, decided by its board of directors, to a class of its shareholders. Essentially, it's a share of the company's profits paid back to you, the owner. Think of it as your thank you check for investing in the business. Not all companies pay dividends. Growth companies often reinvest profits back into the business. But for those that do, it can be a steady source of income. For example, if you own 100 shares of a company that pays a $1 annual dividend per share, you'll receive $100 in cash that year, which you can then spend, or even better, reinvest. Number 10 is equity. This represents your ownership stake in an asset after all debts associated with that asset are paid off. It applies to a home, a business, or a stock. For a homeowner, equity is the market value of your house minus the amount you still owe on your mortgage. It's the part you truly own. For a stock investor, equity is simply the value of the shares you hold. Building equity is a primary way wealth is created. As you pay down your mortgage or as your stocks appreciate in value, your equity, your slice of the pie, grows larger. Number 11 is principal. This is the original amount of money you borrow in a loan or the original amount you invest. It's the base amount, separate from any interest or earnings. When you take out a $20,000 car loan, that $20,000 is the principal. Your payments will be split between paying down that principal and paying the interest charged by the lender. When you invest $5,000 into an index fund, that $5,000 is your principal. Understanding this helps you see how much of your payment is actually reducing your debt versus just servicing the interest. Number 12 is a crucial term when borrowing, APR, or annual percentage rate. This is the true yearly cost of borrowing money, expressed as a percentage. Crucially, it includes not just the interest rate, but also other charges or fees, like origination fees or closing costs. Think of it as the total price of the loan. A lender might advertise a low interest rate, but the APR could be much higher once all the fees are factored in. When comparing loan offers, always compare the APR, not just the interest rate, to understand which one is actually cheaper. Number 13 is your financial report card, your credit score. This is a 3-digit number, typically between 300 and 850, that tells lenders how reliable you are at repaying debt. It's calculated based on your payment history, the amount of debt you carry, the length of your credit history, and other factors. A higher score means you're seen as lower risk, which qualifies you for better interest rates on mortgages, car loans, and credit cards. A good credit score can save you tens or even hundreds of thousands of dollars over your lifetime. It's a number worth protecting. Number 14 is your financial safety net, the emergency fund. This is a stash of money, typically 3 to 6 months worth of essential living expenses, set aside in a separate liquid savings account. This fund is not for vacations or down payments. It's exclusively for life's unexpected surprises, like a job loss, a medical crisis, or a major home repair. Think of it as your personal insurance policy against debt. Having a fully funded emergency fund gives you peace of mind and prevents you from derailing your long-term financial goals when life throws you a curveball. Number 15 is the tool that puts you in control, a budget. A budget is simply a plan that tells your money where to go instead of wondering where it went. It's a roadmap for your income and expenses over a specific period. It's not about restriction, it's about intention. By creating a budget, you are consciously deciding how to allocate your resources to best meet your goals. Whether you use an app, a spreadsheet, or a simple notebook, a budget empowers you to prioritize saving, pay down debt, and spend guilt-free on the things you value. Number 16 is how you profit from investing. Capital gain. This is the profit you make when you sell an asset, like a stock, bond, or piece of real estate, for more than you originally paid for it. It's the tangible result of a successful investment. If you buy a stock for $100 and sell it a year later for $150, you have a capital gain of $50. It's important to know that these gains are often taxable. The opposite, a capital loss, occurs when you sell an asset for less than its purchase price. Understanding capital gains is key to understanding your investment returns. Number 17 describes a happy time for investors, a bull market. This is a period when financial market prices are rising or are expected to rise. The term is often used in reference to the stock market, but can apply to anything that is traded. It's characterized by optimism, investor confidence, and expectations of strong results continuing for an extended period. Think of the bull, which attacks by thrusting its horns up into the air. During a bull market, the economy is typically strong and unemployment is low. It's a time when most investment portfolios are growing. Number 18 is the inevitable counterpart, a bear market. This is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Think of the bear, which attacks by swiping its paws downward. Bear markets are scary, but they are a normal part of the economic cycle. They can be triggered by a weak economy, a crisis, or a burst asset bubble. For long-term investors, they can also represent a buying opportunity, allowing them to purchase assets at a discount. Now for two terms from the cutting edge of technology and finance. Number 19, agentic AI. This is a significant leap beyond the AI most of us know. It's AI that can take actions and complete complex tasks on its own, not just answer questions. Think of it as an autonomous digital assistant. Instead of you asking ChatGPT for a travel itinerary, you would tell an agentic AI to book me the best trip to Italy for the first 2 weeks of September under a $5,000 budget. The AI would then research flights, compare hotels, make reservations, and manage the entire process. This will have massive implications for personal finance, from automated investing to hyper-personalized financial planning. And finally, number 20, hyperscaler. This term refers to the massive cloud computing companies that provide the foundational infrastructure, the computing power, storage, and networking, powering the entire digital economy, and especially the AI boom. Think of companies like Amazon Web Services, Microsoft Azure, and Google Cloud. They are the landlords of the internet. Just as the gold rush made the people selling shovels and pickaxes rich, the AI revolution is generating enormous revenue for these hyperscalers who provide the essential digital shovels. Understanding their role is key to understanding where trillions of dollars are flowing in the modern economy. And there you have it, 20 terms that form the bedrock of financial literacy. If you can understand and explain these concepts, you are already far ahead of most people. This isn't just trivia, it's the language of power, control, and freedom. Mastering this vocabulary is your ticket to participating confidently in your own financial future, rather than sitting on the sidelines.
Let's talk debt. It's the single biggest obstacle standing between most people and building real wealth. You simply can't get ahead while you're bleeding money in high interest payments.
But which debt should you pay off first? The answer isn't always obvious. Let's break down the 3 main strategies. First, the avalanche. This is the mathematician's choice. You attack the debt with the highest interest rate first, saving you the most money over time. Next, the snowball. Here, you ignore interest rates and knock out the smallest balance first. It's powerful psychologically, as those quick wins keep you motivated. And the hybrid, which combines both. You get a fast win for momentum, then switch to attacking the highest interest rate to save money. It's the best of both worlds. There's no single right answer, because personal finance is personal. The best plan is always the one you'll actually stick with.
In Volume 5, I showed you how $5 a day adds up. This time, let's take it up a level. $5 a day is about $150 a month, invested consistently into a low-cost index fund over the years, that's not pocket change. That's a wealth-building engine, thanks to that compound interest we defined earlier. The lesson hasn't changed. The amount isn't what makes you wealthy, the consistency is. Last one, and this is important. We are living longer than any generation before us. A lot of people may spend 30, even 40 years in retirement, creating a financial challenge we've never faced before. Think about that. You could spend almost as long retired as you did working. That means the old plan, work, retire, hope it lasts, isn't enough. You need a strategy with income that outlives you, not just savings that run out. Consider creating different buckets of money for your short, medium, and long-term needs to protect your portfolio. Start now. Start small. But start with that longer timeline in mind. Here's what I want you to do before you click away.
Follow me here and on LinkedIn for weekly financial insights and AI updates. Visit RoxyEZ Educational Consulting for courses, coaching, and digital resources. Share this video with someone who needs it. Every share puts financial literacy in someone's hands. And download my free guide, 7 Money Moves Every Woman Over 40 Must Make Now. Link is in the description. Volume 7 is coming, but share Volume 6 with someone who needs it first. I'm Professor Roxanna Ezenekwe. Keep learning, keep building, and I'll see you in the next one.